Do you want a strategy that outperforms? Then you need a rock-solid ranking system. How do you do that? The three-step process is 1. Have a clearly defined universe. Number 2, research factors for that specific universe. And 3, test the factors individually and in combination with one another. Have a clearly defined universe. Why do you need to have a clearly defined universe? Because factors work differently depending on the universe you use. For instance, dividend yield is probably meaningless in biotech, but highly relevant in water utility stocks. I have selected the universe of the 300 largest dividend yielding stocks with a liquidity filter. And in this quick tutorial, I'm going to use AI factor. It's a bit of a shortcut. Let me show you how it works. When it comes to adding the features or factors that I wanted to test, I simply uploaded a core combination ranking system that includes 6 styles, namely growth, value, sentiment, momentum, low volatility, and quality. I then run this over a 20-year period, and I can look at under prediction and importance, it shows all the features are the factors and how they're correlated to returns. We have both positively correlated, and if we scroll down, negatively correlated to returns. So looking at the positive correlation, we see we have momentum, low volatility, interest coverage, and valuation, trailing PE, forward earnings yield. Let's scroll down to the factors that lead to underperformance, low price momentum, both in the stock and industry group, high short interest, and high beta. Now we'll develop a ranking system including these factors. So I went ahead and I've made this ranking system. I like to put them in neat folders according to style: momentum, low volatility, risk, and value. So here we have the 1-year momentum of the stock and the industry group. I also did that for the 6-month. Low volatility or stability, we have low standard deviation, low beta. For risk, low short interest, high interest coverage over the last 12 months. And for value, we have projected price to earnings ratio and trailing PE. So let's go ahead and run a back test, but just be aware I have already introduced some bias because my testing period for finding what factors that work, I'm now back testing in that same period. So it's really important that after you go through building your model, you try to figure out what is the connection between the factors and performance. If it's just a mishmash of factors that doesn't make sense, you shouldn't use it. There should be a clear connection as to why these factors work in this universe. I select as my stock universe the top 300 dividend yield. So in the backtest tab, I set the period from 1999 till current. We rebalance every 52 weeks. And here is our performance down here. We have in our universe 9.34% annualized return, drawdown minus 66%, sharp 0.47. So that's all the stocks in our universe. Now let's go ahead and let's just select the top 20 stocks. Okay, so here's the performance numbers. It seems to have improved our return, lowered our drawdown, and increased our Sharpe ratio. But now it's important to go through the factors one at a time to see which ones are leading to outperformance the most, because just having a number, say it outperforms by 3%, but not actually seeing the equity curve, this can be misleading. I'll show you what I mean. Let's go into the ranking system, go into weights, and I'm going to put all of the weight. You can see 100% weight into the value. So now let's see how it performs with just the value rank. Yikes. We do have some outperformance, but you can see 83% drawdown, value trap city. So let's go back and do exactly the same for each of the styles. We're going to say momentum. Run the backtest. Okay. Let's do this again for low volatility. And finally, for the low risk, which is low short interest and high interest coverage. Well, it looks like we have a clear winner here. We like our low short interest and high interest coverage as a system. So from here, we can go in combination. We could, for example, try low risk and low volatility. Now I'm just going to stop the tutorial here because this is going to take a lot of time, but you should see the basic process for finding factors, researching them, and then testing them. But there's one more thing you can do. When you're in the ranking system, Let's just run just the risk. Okay, now you're going to hit performance. Max, make sure our universe is the top 300 dividend yield. Our benchmark is the DVY ETF. I'm going to put 10 buckets and let's run it. Okay, so over the 25-year period, you can see how low short interest and high interest coverage reacts with our universe of stocks. You can scroll down and you can see versus the universe of stocks, highly ranked bucket, low ranked bucket. Scroll down to see the individual years of excess return, outperformance or underperformance. And here we have an average of 30 stocks per portfolio sort. So from here, you're going to want to keep experimenting and keep testing different factors that will interact with high interest coverage and low short interest ratio. If you like this video, please consider subscribing and be sure to stay tuned for more videos to come.